Okay, we'll make a start. Welcome everyone to today's session. I am sure I've come across most of you or you are clients, so it's lovely to see you engaging. Just some housekeeping matters to deal with first. If you cannot hear or see anything, you are able to join via computer audio. The details are there on the screen for the dial-in number and access code. I do not pretend to be any expert when it comes to computer and IT, so if there are any technical issues, I will apologise. It's unlikely I will even know, so please bear with us. Don't hesitate to ask any questions as we're going along. There is a chat function on the webinar, so please feel free to ask any questions, and if we have time at the end, we'll address them on the session. If not, then I'll be able to get back to you via email or call after the webinar. Please feel free to contact me directly as well. My details are on the screen. It's louise.casey@mitchellcharlesworth.co.uk. The session is being recorded and will be circulated along with the slides, so please don't feel like you have to take too much of excessive notes as we're going through. So just before we make a start, just a bit of an introduction from me and MC. So I'm Louise, I'm one of the partners here at Mitchell Charlesworth, and I've been working in the housing sector for a number of years, having been at MC for 15 years. MC have been working in the housing sector since the 70s, so a lot of experience as the landscape has changed over that time, and we're really proud to work with the sector. We've also been doing some work with the National Housing Federation in respect of bringing new auditors into the sector with quite a few shortages and training and development in that area as well. Our housing team does span across our Liverpool and Manchester offices, and we currently act for over 40 providers from below 100 units right up to 12,000 units with a full range in between. So that's enough about MC. Let's make a start because there is quite a lot to get through in today's session. So as you will be aware, the SORP 2026, which is hot off the press, being released only 2 days ago, brings in a substantial change to the housing SORP and the underlying reporting standards that we have to apply in preparing accounts, and you as users of the SORP will have to apply in your day-to-day finance role. So in summary, and the National Housing Federation summarises this really well, the SORP purpose is really to provide recommendations and interpret the standards based on FRS 102 for housing associations. And this means that it then becomes best practice. And I think this SORP actually really does give some really good practical examples of how to apply FRS 102 with the sector specific nuances, particularly around regeneration, shared ownership, etc. So as we touched upon, FRS 102 changes, biggest shake-up since the move from UK GAAP to FRS 102 a number of years ago, and the purpose has been to align with IFRS reporting, and there's two really big areas in which there's been a significant overhaul, but the SORP has also taken the opportunity to refresh the SORP, revisit and look at some of those areas that have evolved for the sector since the last SORP update back in 2018. So I think if you look at the changes in almost two layers, so the first layer being the FRS 102 mechanics, so this is essentially FRS 102 being the foundation of the financial reporting framework, and then the second layer is the SORP interpretation for the sector and how we will apply that in practice. So as many of you will be aware, consultation opened back in October 2025, completed in January 2026, and then the final SORP was published on the 13th of April. Now, of course, during that consultation process, we did have the opportunity to have a look at a lot of those key changes and see how they would apply in practice. And the final version is pretty much what was anticipated. There have been a few items that have not changed and have been reverted back to the previous SORP version, but we will cover that as part of the session today. So just touching on changes to narrative reporting, and I think from a narrative reporting, anyone who I've presented to at committee meetings or board meetings will have heard me use the phrase, you know, it's the story, it's telling the story, it's celebrating the successes, and it's putting some context behind where things may not have gone to plan. And whilst the narrative reporting content hasn't greatly changed, I think what we will see as we go through today's session, a lot of these changes are going to need an explanation. They're going to need, you know, quite a detailed review of why metrics have changed. And the annual report, as it will now be referred to, is the perfect opportunity to do that. So the key area from a narrative reporting change as a result of the SORP is that it is going to be renamed the annual report from the strategic report. And this is to save confusion with obviously the requirements of the Companies Act, but also reduce the level at which the annual report is required. So we've now got over 1,000 homes rather than previously the 5,000 homes that the old SORP had. So I think when we're looking at telling that story, we're not just looking at, you know, what's happened in the area, it's what's changed operationally, what's changed because of the changes in standards, why does the balance sheet look different, why has EBITDA moved, and why are the metrics slightly different. And we'll look at each of those in turn as we go through the presentation. So many of you will be aware that the two significant changes arising from FRS 102 are in relation to the revenue recognition and the introduction of a 5-step model, and also leases and bringing in those right of use assets. So we're going to look first at revenue recognition, and I will caveat that this isn't as detailed as the presentation I gave a few weeks ago for the corporate entities. So for those of you that do have subsidiaries, development companies, any sort of repairs and maintenance companies sitting below you, and below the housing association, or if you do offer those services within the organisation, it would be worth having a look at that webinar, particularly just on this revenue recognition, because it does go through quite a bit more detail in respect of debundling of services and applying those 5 steps in a practical sense. But for today, we're going to look at it from a bit more high level. Obviously, the main and core sources of income for a lot of you will be revenue from contracts with customers. So this will be service charges or maybe some repairs and maintenance services. And we will be looking at FRS 102 section 23 for that area. You'll have non-exchange transactions. So this is linking into SORP chapter 15 in respect to specialised activities. Your core income, rental income from leasing arrangements, which will follow FRS 102 section 20 in respect of leases. And then there will be grants as well, which follows FRS 102 section 24 in respect of government grants. So a little bit of jumping across various sections in respect of both bringing in section the SORP, but also going back to the original FRS, which the SORP is referring to. So when we talk about the 5-step model, it is quite a practical shift away from the principles-based, when is it earned approach, and towards a more structured model where there are explicit requirements at each stage to break down that contract and really understand what is involved in providing that service. So step one, as we can see here, is identifying the contract. What does the contract say? What do we understand from that contract? Where are the key recognition points? Step two is identifying the performance obligations linked to that contract. So where are those key milestones that we need to really understand to identify when we would meet that obligation? Step three is determining the transaction price. And here we're looking a lot more around what transaction price is relevant to that stage or that item within the contract. Step four is allocating that transaction price to the performance obligations within the contract. And then finally, as we get to step five, we can recognize the revenue if the entity satisfies that performance obligation. So there's a far greater focus here on the performance obligations, taking into account any variable aspects of it, and also that timing of recognition. So this is really where housing providers are going to need to unbundle the headline charge, so the total contract price, and it might include multiple services being delivered in different patterns. So the risk isn't really getting the recognition wrong, it's also making sure that the presentation is correct. And what we will likely see as a result of this change is more recognition as contract assets or liabilities as opposed to accrued income or deferred income, because we're really going to have to understand what the contract is and when those amounts become recoverable. As I touched upon, very relevant for those of you who do have trading subsidiaries, but also relevant when we look at service charges. So from a service charge point of view, it is deemed to be treated under Section 23. And historically, many of you will have used practical approaches based on annual budgets, recoverability, cash collection, etc. But the revised model is really pushing you towards identifying those promises, those performance obligations, and recognize them as you deliver. So that will tend to pull you towards better separation of those service charges components and a more explicit estimation of any variable consideration that is estimated throughout that. You've also obviously going to have to look at any bundled income streams. If rent and service charges are bundled together, debundling of those service charges so that we can make sure that the rental income is being treated under the Section 20, and then the service charges are being reflected under the Section 23. And with that variable element, there is a level of estimation and judgment, and this is really going to be driving both the disclosure perspective, but also the calculations of when that income is recognised. So I've just given an example here. So example service charges for communal services. So we're going to identify the contract. Obviously, there'll be a tenancy agreement. In that tenancy agreement, there will be details around the service charges. Identifying the obligations and promises. So is it cleaning, ground, safety checks, repairs, etc. Determining how you have calculated in the past. Is it a fixed? Is it stipulated by the contract? Or is it variable level determined at the beginning of each year based on an estimate and then flexed at the end of the year to take into account actuals? And then you're going to have to allocate that charge across those obligations and then recognize revenue as each service is delivered. You can estimate variable consideration and that expected over and under recovery, but it's likely you're going to have to do that at different stages as you're recognizing that service income. Other areas of revenue recognition to note, so non-exchange income and grants, not a significant change here. It is linking back to FRS 102 section 24 as it always have, but the Housing SORP now gives a bit more guidance around the presentation and disclosure within the accounts. In respect of revenue recognition and leasing arrangements, it does now define the standard rental agreements fall within the section 20 in respect of leases, and on the main is recognised on a straight line basis, with any rents in advance being included as deferred income. Now, it is worth having a little read. There are some exceptions, albeit I haven't at all seen that in practice. But if you do have any sort of slightly different agreements, it is worth having a look at those exceptions to the rule. So moving on to the second most significant area of change, and that is in respect of lease accounting and right of use assets. I think it's probably prudent to say here that in respect of income and lease accounting in respect of income, there have been no significant changes in respect. However, if you are paying out to lease assets, whether that be land and buildings, office premises, plant and machinery, cars, this is very relevant. So what we're seeing is it moved towards greater transparency in financial reporting and mirroring what is in IFRS. Historically, obviously, operating leases have been treated as a rental expense and recognised on a straight line basis. And what we're going to see now under the new model is that they become to be right of use assets. And we'll look at this in a bit of detail. But I think it's really important to firstly understand what the contract is. So the contract is, obviously, you can use that right of use asset for a period of time in exchange for consideration, and you have the right to control that asset. Operating leases will be recognised on the balance sheet, and as we come to look, that is going to have an impact on metrics and potentially covenants. And that operating versus finance lease distinction has been removed, and the lease liability will need some area of judgment in respect of anticipating what the discount rate is to bring that to the present value of the future payments. So we've just put on here a little table just to sort of summarise what we need to consider when we are looking at leases. And this needs to be done for each individual lease. It's not sort of a one shoe fits all, unfortunately. So it is going to need some time and consideration around how you pull together this information to be able to conclude on what needs to be presented in the accounts. So obviously, from a present value of future cash flows, what is an appropriate discount rate? What are the lease term? What's the lease term to calculate it over? Is there a non-cancelable period? Is there an extension option? Could you terminate the lease? Is there a break clause? What's the likelihood of you doing that? Can we look at past history to see what has happened? And is it reasonable, cost effective to break or extend the lease? Have you made significant leasehold improvements? All of these things are going to be considered when you are looking at the term of the lease, and also when we're looking at the initial direct costs incurred. So are you accounting for any non-lease components, bringing that into use? Any restoration fees at the end of the lease that are sort of contractual and binding that need to be brought in and considered as part of that right of use asset? Are there any lease payments or lease incentives received? Because they will need to then be pulled into that original right of use asset calculation. And as I've touched upon, the dismantle or restoration costs also need to be brought in. And again, there will be an element of estimation and judgment when trying to calculate that. So looking at the initial measurement, once we have established our period, we've established our discount rate, we've considered within that discount rate the interest rate implicit in the lease, or if this isn't available, we would then default to what the SORP and FRS 102 are directing us to, which is what rate would it be if you borrowed that money to obtain the asset of a similar value over a similar period. And then the standard does give definitions for incremental or obtainable borrowing rates so that you can look at that. And that must be on a lease by lease basis. So we're not underestimating how much work is going to be needed in dealing with this before the March 27 year ends. So once we've established that and the variable elements, we will then look at creating our right of use asset by debiting our assets, so fixed assets for the lease, total at that discounted amount, with a corresponding lease liability. So we are going to be replacing in the profit and loss a straight line operating lease with the depreciation and interest charge. Now, what you would imagine is actually over time, they will net off to be the same amount. But there are two aspects to really consider here. The first one being, obviously, if you are discounting something, you're going to have a higher cost to begin with, and that cost is going to reduce over time. And then the second aspect is we are taking out of, above profit an operating lease expense, and we are replacing it with depreciation and interest, which are both added back when we do our EBITDA calculations and various other metrics. So really important to understand what the impact is going to be on the financial statements, and make sure you are engaging with funders, etc., nice and early, so that they know that it's going to be a change potentially in the metrics. If there is no formal lease, there is an implied lease if it's being paid, and if it's being paid over a number of years. So special care needs to be taken in that regard. There are some exemptions to this, and that is that low value assets or a lease term of under 12 months with no purchase option do not need to fall under the right of use asset calculation. Now, when it comes to low value, it doesn't tell you what is low value, but it tells you what definitely isn't low value. And there's a list on the slide, but cars, vans, etc., equipment, land and buildings are not deemed to be low value. Our interpretation of what may be considered to be low value are the likes of mobile phones, photocopier leases, laptops, so very small value. Obviously, if they are below 12 months, you just need to document and evidence that. So once we've got our right of use asset with our corresponding lease liability, we are going to reduce that lease liability by the payments and the unwinding of the interest. The right of use asset will be held at either the cost or revaluation model, with the need to consider impairments and any dismantling provisions, as I've already mentioned. And that can then be presented either as a separate line on the balance sheet as right of use assets, or just broken down in the fixed asset note. However, the disclosure is more extensive, and you do need to give a description. You need to disclose what the expenses were relating to the interest, what is the total amount on short-term leases and loan valued assets. And obviously, from a cash outflow point of view, it will impact the cash flow. And you will also need to provide a reconciliation of those right of use assets. So as I've mentioned, impact from a financial statement point of view for the statement of cash flows is obviously operating leases previously disclosed in operating activities, but we're now going to see financing activities disclosure. You will need to understand how your internal accounting systems will account for these right of use assets. You will need to do a more detailed assessment of those more complex leases, or those that have, more steps in them, or more costs associated with bringing that asset into use, or a dismantling provision at the end. And obviously it is going to impact KPIs and reporting as the balance sheet grows and costs become more front loaded. And those, as I've mentioned, the resulting impact on any banking covenants. So I've just given a practical example here. So we've got a property rent, £50,000 per year for an office space, 5 years remaining on the contract. So we would recognise that under the old SORP on a £50,000 straight line per year. Under the new SORP, we're now going to calculate the total commitment, so 250,000. We would then need to discount that to present value and recognise that as an asset and a corresponding lease liability. Subsequently, that asset would be depreciated over the 5 years, and then the lease liability would be unwound by payments and that front-loaded interest release. And we've already touched upon the impact on the financial statements and both on operational and compliance as a result of those changes. I'm not going to go through this slide in great detail. As I said, you will get the opportunity to have the slides. But just from an impact and covenants point of view, obviously EBITDA is going to increase, net debt is going to increase, interest expenses are going to increase as a result of these changes. So if you have particular covenants that are EBITDA driven, if net debt, interest cover, working capital, you are going to have a look at what these changes mean to you as an organisation, and are they going to impact materially upon these calculations. From a transition adjustment for these two major changes, it broadly expects entities to apply the new rules using a modified retrospective approach, which means that you do not need to restate all your comparatives in full, and you recognise the impact as an opening balance adjustment at the start of adoption. You will need to provide enhanced disclosures in respect of what those transition adjustments look like, and a reconciliation between the old SORP treatment and how it's now being treated, so the user of the accounts can readily understand the impact of these changes on the organisation. And as I touched upon when we discussed the narrative reporting side, obviously really key is making sure that the annual report supports what's happened and explains the impact of those changes to the user of the accounts. Slight difference on income is that you can choose retrospective or modified retrospective, but I think it will be very unlikely that anyone doesn't just show that through opening reserves. And from a lease's point of view, you are expected to recognise the right of use assets at the date of transition, rather than having to recalculate previous profit and loss statements and impact on the balance sheet. And there's no restatement of comparatives required in respect of that. So they're the two major changes, but that's not to say that there aren't a number of other changes. So the next few slides are going to look at the other aspects of the SORP and FRS 102. So supplier finance arrangements. So this is more of a disclosure change than a sort of metrics change or how you're actually calculating. So even if the recognition doesn't change, that transparency does. So essentially it was effective from the 1st of January. So it was a new disclosure last year. And it essentially is, if there is any element of financing within trade creditors, is it actually deemed to be debt? And it's looking at, is it trade creditor or is it borrowings? And that's just something that is embedded into the contracts you may have with some of your suppliers, and a review will be needed to whether you have any arrangement that meet that disclosure definition, and making sure that you review those loan agreement definitions to see if it should be reclassified as borrowings instead of trade creditors. Grants. So as we touched upon, not a lot of change in respect of grants, but it was decided that a grant received from another register provided in a stock transaction or swap will not be recognised on the balance sheet. So this reverses a proposed change, but they have enhanced the contingent liability disclosures within there. So I think that is one of the examples of, it was in the consultation, there was a bit of recourse on it, it has been removed and remains as it was. And in respect of asset swaps, there is clearer guidance now on the valuation and timing of that grant recognition. So it moves these from specialised activities to the main housing properties chapter within the SORP. There are also changes to fair value and conceptual updates, so particularly around financial instruments. So there is a new section, which is section 2A, which is called fair value measurement, and this replaces the appendix to section 2 of FRS 102 as previous. So this incorporates and ties in more to the IFRS 13 fair value measurement. So the key changes here is really understanding that if you have a non-basic financial instrument, so some examples here, derivatives, converted debt, some pension schemes and employment benefit plans, if they hold investments or annuity policies, accounted for at fair value, and investment funds where the scheme is measured at fair value. So what it actually is doing is it's introducing this fair value hierarchy. So it's understanding how you are valuing those instruments. So those 3 levels of fair value start with level 1 being quoted prices in an active market for identical or comparable assets or liabilities. So that's probably the least judgmental of the 3 levels. Level 2, a price from a recently orderly transaction between market participants for an identical or comparable asset where there have been no significant changes. So this is the observable inputs. So if you've got interest rate swap or broker quotes, they can be used at level 2. And then at level 3, this is more of the unobservable input, so other valuation techniques that provide the best estimate of fair value. Obviously, from a fair value point of view, the less subjective, the better. And you need to understand that if you have that active market and you're using that to value, that is going to be far better than, trying to evaluate those unobservable inputs. So for non-financial assets, fair value must reflect the asset's highest and best use from that market, even if the entity uses it differently. So really, really important that you understand those acceptable valuation techniques and are applying them consistently when you are revaluing any financial instruments you may have. Other changes, so a number of changes to housing properties, linking that to regeneration, impairment, provisions and capitalisation. And I think this is where the SORP's role is most valuable, because the aim is to reduce diversity in how the standard is being applied, what is capital, what is revenue, and how to treat that expenditure. And I think the SORP gives really good practical examples as to how you can apply that in practice. So the core discipline for all of these areas remains that you will capitalise only where there is an incremental economic benefit, otherwise you'd expense it. But it does bring in, and we'll touch upon this in a bit more detail, that where obligations exist, whether they be legal or constructive, for any remediation or compliance related spend, then disclosure starts to become more judgmental, and more documentation and consideration will need to be given. So looking at some of these changes, got asset capitalization, so including building safety, sustainability, and decarbonisation. So as I mentioned, these are where the incremental future benefits are arising. So there's new guidance on impairment considerations for right to buy and right to acquire, or right to shared ownership. And this is particularly relevant when there are plans to dispose of an asset before the expected date. There is a whole new section on regeneration schemes and the consistency of accounting treatment. And particularly here, it's highlighting that, when is that first point of derecognition? And it explicitly states that that's at the demolition stage. And then the decision to proceed with regeneration triggers the reassessment of the residual value or useful life. So some interesting reading there, which has been brought in as a new aspect to the SORP. And just staying on the theme of housing properties, provisions. So whilst the definition for provisions hasn't necessarily changed under FRS 102, there is enhanced guidance to clarify when you can recognise a provision, particularly for future costs related to non-compliance with regulations. And I know I've had a number of discussions with the clients I work with around, if you are in breach of building safety or decent home standards, at what point can you start to recognise that provision for spend that hasn't yet incurred? So there is still no provision for future costs that can be avoided by future actions. And it does give some examples of what that means. And restructuring costs can only be provided for once a constructive obligation exists. So I would say this aspect of the SORP is worth a read, because it does take it a step further in respect of identifying the types of costs we're starting to see and when you would look to recognise those in the provisions. A few other areas worthy of note. So we've got shared ownership and repairs. So the specific guidance for repair responsibility, and this has really been aligned to the changes we've seen since 2022 under the new shared ownership models. So it's just bringing in something new as a result of what's been happening in the sector anyway. Sustainability and building safety. So there's additional guidance on capitalisation costs and when you would recognise those. Incidental costs. So if you've got a development or a regeneration, the new guidance confirms that non-essential costs, for example, temporary accommodation or patrols, must be expensed and not capitalised as a result. And then another item that was in the consultation but has subsequently been removed was an alignment to what we see with the charity SORP in respect of disclosures of salary banding for staff earning over 60,000. So this has now been removed and leaving this to the regulator and the accounts direction requirements, as opposed to bringing in new requirements under the SORP. So we sort of touched upon this as we have gone through the presentation, but I think a key message for you in your organisations is that metrics are going to likely move, even if there is no cash change. So it really means that you're going to have to translate what these changes mean, how they're going to impact those metrics, and give some context behind that within both the statutory accounts, but also when you are corresponding with lenders and other stakeholders. So some useful guidance here would probably be producing some pro forma reconciliations to explain to boards where you've gone from and where you're moving to, being quite explicit on where there are presentation changes to actual financial changes, agreeing any covenant mechanisms. So if you need to have a look at your covenants, looking at if there are any frozen gap clauses or definition carves out, or recalibrated thresholds, just so that you can really understand those discussions with the lender. And then internally, your day-to-day operations, your reporting are going to have to maybe look at assessing those definitions and how that will impact on your monthly reporting and internal reporting. Obviously, we've got here fair value changes and therefore the impact they will have on some metrics. Sorry, I'm realizing that this light is going on and off, so I apologize if it's causing any issues. I can't actually see, so I can just see the light going on and off. So here we're going to have an impact on metrics if we have different hierarchies being selected, and it gives some examples here of when we would be using some of those various levels. I think the key one here is really bank loans, because that's probably the one that a lot of organisations will have. So they are normally amortised, held at amortised cost. The fair value is usually fairly straightforward because you do have that implicit rate in the loan agreement. If you don't, and you are looking at fair value, then you will be using market yields for similar instruments. But I think that's quite unlikely, given that the implicit rate is the majority of the time stated within the agreement. So from a presentation and disclosure point of view, what will look different in the accounts? And I think this is the key area around not just looking at this from a numeric perspective, but also that narrative perspective. So there are expected areas of increased disclosure. There are going to be changes from potentially revenue and certainly leases for those of you that have operating leases. You're probably going to have a lot more narrative in your key judgments and estimations perspective around those income and leases. So, for example, how did you identify performance obligations? How have you separated lease and non-lease components? How you've determined discount rates? How the fair values have been evident. So we will probably see a bit more around that key judgments and estimations within the financial statements. And it's not really just about technical compliance. It's also about not allowing misinterpretation by lenders or regulators and other stakeholders when they're reading those accounts. So I would always say over disclosure of those key judgments is only to your benefit. And I would also say early engagement with audit teams as well is really important to ensure that what you are documenting and how you're calculating is in line with their expectations, and to avoid any sort of disagreements later down the line or having to rework disclosures. So I think from a presentation and disclosure point of view, there are quite a few things to consider, especially when we are looking at that lease disclosure, revenue disclosure, and the transition to the new reporting requirements. So I've just popped on here a few points that I think are relevant for preparing for the new SORP. A lot of you will have March year ends, so now's the time to be planning, because obviously it's relevant for March 27 year end statutory accounts. Those of you with December year ends, December 26 will be the first year of application. So assessing those reporting requirements, looking at those key changes and understanding how they apply to you as an organisation. And as I've already touched upon, I don't think it is going to be a one shoe fits all. Reviewing governance and reporting, and I think identifying gaps in the reporting, but also focusing on the compliance with the new standards, and most importantly, that communication piece. This is what it looked like, this is what it's now going to look like, so that everyone is fully understanding the impact it is going to have across different business service lines. So engaging stakeholders and performing training, so training for boards, communicating to stakeholders, early liaison with funders, and looking at covenants and understanding how they are going to impact. And then obviously the big piece, which I know a lot of you are already on with and reviewing, is assessing those lease agreements, understanding what the contract is, what the period of time is, what the implicit interest rate is going to be to build on that calculation for that right of use assets, and also looking at those service charges and seeing how material these changes are in respect of the debundling from the rental income, and trying to understand at what point they should be recognised, particularly if you are applying variable rates of service charges. So that was a whistle-stop tour of the key changes. I will just go to the chat to see if there are any questions. There are no questions yet. But please feel free to contact me or any of the housing team. We'd be more than happy to support you on any questions you might have, or if you want some more practical examples. As I mentioned, certainly on income, the corporate webinar I did a few weeks ago is available on the website, and that goes into a lot more detail around those income changes. I hope you have found that useful. There are no questions coming in, so we will finish there. As I've mentioned, the slides and the recording will be available, so please share it with your teams, and more than happy to field any questions as they arise. Thank you all for your time, and I will speak to you soon.